Great. Well, thank you, Tara. Welcome, everybody. I'm going to say good morning, but it's good afternoon, depending on where you are joining us from today. So today we're going to talk about some California updates, some issues in California, really some topics that we received quite a few questions on. There are areas that people that are, hopefully will be very helpful for clients that are, maybe have started doing business in California, or are looking or considering doing business in California. And talk about some updates, like I mentioned, and then also some, just things to remember. There's always some little quirky things about California we just want to make sure everybody is aware of. So with that, we will get started here with our presentation. Our presenters today are myself. I'm Jennifer Edwards. I'm a manager in our state and local tax group here at Eide Bailly. I'm located in the Sioux Falls, South Dakota office. We also have Stacy Roberts. She's a senior manager in our SALT practice here at Eide Bailly. She's in the Denver office. And Laura Robichaud is also a senior manager with our state and local group, and she's located in Phoenix. So with that, the things we're going to talk about today here in our during this presentation, I'll get started and talk about opening and closing a business, and kind of whether you're actually have physical presence or a physical location in California, or just starting to transact business as an out-of-state retailer, some of the registration requirements, some steps that need to be considered before getting started and doing business in California. Then talk more about doing business, factor presence, touch on, just define and give a little more information on the NEXUS rules and for sales and use tax and franchise purposes. Then I'll hand it over to Stacy, and Stacy was going to talk about California income sourcing, withholding on California sourced income, when that's required, and then talk about the franchise tax form reportings, which forms are required for based on the type of entity that the business is. Then Laura is going to talk about California sales tax, some common problems that clients tend to run into. She's also going to touch on sourcing and filing frequencies for the California sales and use tax returns. And then we'll pass it back to Stacy, and she'll wrap it up for us, talking about some notable California tax updates and reminders that we want to make sure everybody thinks about as they go into planning for year end and the beginning of a new tax year. So with that, we'll get started with opening a business in California. And this is kind of a general term, and really what I'm thinking, when we think of opening a business, you maybe think of actually a physical location, like I mentioned, but it could really just be starting to make sales to customers into California, maybe have some other presence, have salespeople going into the state. So that's kind of what we want to talk in a more broad term. So as you get started and start thinking about transacting business in California, some of the agencies within the state that we want you to be aware of that you may have some registration requirements for would be, first off, the California Secretary of State. The Secretary of State, that is, where you would file any of your organization papers, incorporation papers, paperwork. Really, registering with the California Secretary of State is what gives a company legal standing in the state of California. So we'll talk a little bit more here in a little bit as to when do you need to register and contact the Secretary of State. One of the next agencies is the Franchise Tax Board. In the Franchise Tax Board, this is the agency that oversees franchise, corporate and personal income tax, really kind of oversees all of that area of the tax, of more the direct taxes. One of the agencies on here that you may not see that you're used to seeing in California is the State Board of Equalization. Well, effective as of July 1st of 2017, the State Board of Equalization was restructured into 3 separate entities. And those entities are the State Board of Equalization, the California Department of Tax and Fee Administration, or the CDTFA, and the Office of Appeals. Now, instead of having one agency that has oversight over all these taxes and dealing with any appeals or any protests, they've kind of broken it up into these different entities. What is now the State Board of Equalization, it's an independent agency, part of the state, and it will oversee property tax, alcoholic beverage tax, and insurance tax. And then the Office of Appeals that was set up, again, is also another independent agency, and that their function will be to hear any appeals, protests, to really be kind of the enforcer of kind of more on the legal type side of any issues that companies or entities would have in the state. The other agency here, the California Department of Tax and Fee Administration. This agency is actually housed under the government operations of the state. And this agency is the one that will now oversee most of the taxes that the State Board of Equalization had always overseen. So sales tax, use tax, property taxes, basically any other taxes that other than the three that the State Board of Equalization and franchise tax, but they will not oversee a franchise tax. But anything that the State Board of Equalization had overseen in the past, that's what the CDTFA. So when we need to register, that would be the entity that we would register for sales and use tax. And we'll talk about that here in a little bit. The Employment Development Department, that would be where if you have employees or payroll in the state, that's the agency that you would need to reach out to. And then lastly, the Governor's Office of Business and Economic Development. For certain industries that would have specific business permits, that's where you would, the agency you'd contact for those. So when does a business need to register with the California Secretary of State? Basically, if you are organizing or incorporating in the state of California, obviously, then you definitely have to register with the California Secretary of State. For a foreign entity, and when we're talking about foreign entity, we're just talking about any entities that are organized or incorporated outside of the state of California. So before for a foreign entity, before they start transacting any intrastate business in California, that is when they would need to consider registering with the California Secretary of State. And transacting intrastate business means that the entity or some part of that entity enters into or conducts repeated and successive business transactions in California. So that's really the key, is the repeated successive business transactions. A foreign entity or a foreign corporation that is maybe just a shareholder in a domestic corporation operating in California, or a shareholder in another foreign corporation that's transacting business in California. If they're just a shareholder in that generally is not, would not create a requirement for them to register with the Secretary of State. Being a limited partner in a domestic limited partnership or in a foreign limited partnership, provided they're not doing any other activity in the state of California, would not require them to register with the Secretary of State. But if there's an out-of-state entity that is conducting significant business over the internet, making a significant amount of sales, although they don't specifically define significant, but making significant sales over the internet could potentially create enough of a connection with California that it would allow California courts to exercise personal jurisdiction over that entity. So if you are making many, doing a lot of internet sales to customers in California, probably it's be wise to just consider that and look into what potentially if we need to register with the Secretary of State. So then after the Secretary of State registration, then we would look at when does a business need to register with the California Department of Tax and Fee Administration. And this would be mostly what we're looking at specifically here would be for sales and use tax purposes. So, and we'll talk a little bit more about the actual nexus, but if you are, the general rule is an entity that is engaged in business in California and their intent is to sell taxable tangible personal property at retail in the state. Those would be the general rules as far as when you need to consider registering with the CDTFA for sales tax purposes. And then lastly, when does a business have a franchise tax filing requirement? And again, we'll talk a little bit here more about Nexus, but generally, when a business is doing business in the state of California, they have exceeded the factor-based thresholds, which we'll talk about here in a little bit, then they would have a filing requirement for franchise tax purposes. One thing about California, the penalties are quite significant and can be quite steep for companies that have registered and then have not followed through with the proper tax filings that need to be done. So it is something to be very aware of. We've had instances where employees of clients will have gone, they know they're starting to do business in these different states, and so they kind of get excited and they start registering around the country, and they've registered in California, but then maybe either didn't let anybody know or didn't ever follow through as far as filing returns, or maybe possibly even the the business activity they thought was going to start in California didn't actually occur, but they still were registered and never went through the withdrawal process. California, they will send out notices, and they it's not uncommon for them to send out notices, and there can be some very high penalties. So just be aware of that, and be sure to know where you're registering, and where and when you're registering in the state of California. So on this screen, we just have some of the different forms that need to be filed if you're registering with the Secretary of State's office. You can see on the left side is the business structure. And then in the second column, the forms, the domestic or foreign. The first one is listed. That was what a domestic corporation or a domestic entity would file with the Secretary of State, and then the bottom one would be what a foreign. So for example, a limited liability company, a domestic would file LLC 1, and a foreign entity, a foreign LLC would register that LLC 5. As you can see, many of the costs of registering and the fees associated with that are similar regardless of whether it's a foreign or domestic entity. So California minimum franchise tax. Registering in California can get to be quite expensive mostly because of this California minimum franchise tax. So the minimum franchise tax is a tax required of all entities that are transacting business in California. Generally, the rules would be if you're doing business in California, if you're registered in California or organized in California, you're subject to the minimum franchise tax. And we talk about getting registered with the Secretary of State and those sorts of things, and then most definitely you have this minimum franchise tax. Even if you're starting to do business in the state of California and you've exceeded some of those nexus thresholds, this minimum, the entity would still be subject to these minimum franchise tax. So when is the California franchise tax due? And this, really what this question is, we want to really talk about it from the standpoint of when a company is, or entity is just beginning to do business in California. So for entities such as LLCs, when they first start getting registered, this tax is due when an entity starts doing business in the state. So for example, for a domestic LLC, they have 3.5 months after formation to file their initial minimum franchise, the $800, and this is the $800 tax that we're discussing here. A foreign LLC that's just getting registered, their minimum tax, $800, is due when they first begin doing business in the state. There is a first-year franchise tax exemption for C corporations. So the California Franchise Tax Board waives the first-year minimum franchise fee for new corporations that qualify or register with the Secretary of State. This first-year exemption only applies to C corps, but it also does apply to S corps, LPs, LLPs, and LLCs that are taxed, that elect to be taxed as a corporate entity. So if it's a corporate entity, they do have a one-year exemption. So their first payment, their first minimum tax would be due in their second year of operation. But going one step further for an exemption, and there's a 15-day franchise tax exemption, and this exemption really applies to all types of entities. So if a entity is registers after, like say, on December 18th, and they do not transact any business in the state of Colorado, or excuse me, in California through the end of the year, they would not have to pay that initial $800 minimum franchise tax. It would not be due until for example, like March or April 15th of the following year. So you do get a little bit of grace, but the key part is the registration or doing business started within the last 15 days of the year, and there were no business transactions that took place during that 15-day window. Sales tax registration. So in order to be subject to the tax, sales tax registration, it's engaging in business in California. So really what we're looking at here is NEXUS. And NEXUS is the sufficient connection a business entity must have with a state in order to subject the entity to that state's laws. So for example, on the sales tax side, engaging in business, generally what we think of as physical location, employees in the states, leasing machinery and equipment, having affiliates if you're receiving income through those affiliates, whether they're being through websites, there are specific guidelines for that. For example, that you have to have through those affiliates $10,000 in sales to California customers through those California-based affiliates, and the in-state sales have to exceed more than $1 million in the preceding 12 months. So those are the requirements through an affiliate to create NEXUS. Presence at a trade show, it can create NEXUS if you're making a sale. Most of the time you're there less than 15 days. And as long as the income is less than $100,000, that doesn't create NEXUS. However, if you are making sales, you may need a temporary license and then would still need to collect on those particular sales. A question that we get quite a bit now, as more and more businesses start selling and using through third-party warehouses such as Amazon and Fulfillment by Amazon, is inventory in a physical location in the state is enough to create a NEXUS in a registration and a filing requirement in California. Some of the common sales tax registration, we've got seller's permits, and so a seller's permit would be for a domestic corporation or entity, or an entity that is engaged in the state of California, again with the intent to sell taxable personal property. Out-of-state retailers maybe don't meet the requirements for the seller's permit, but if they are engaged in a business in California, they may have to apply and file the use tax. And then what those entities would then have to do when they make any sales to California customers, they would have to withhold and remit California use tax on those. There is an option for a temporary license, as I alluded to just briefly. Laura will talk about that a little bit more in her section. So that brings us to our first polling question. True or false? Domestic LLCs file the same registration forms as foreign LLCs.
All right, and while we wait for the answers to come in on these polling questions, let's go ahead and answer one of the questions that's come through the chat. So, if one of 30 plus employees lives in California and an otherwise non-California business, is registration required?
So they actually have an employee. Does the employee lives in California and works in California, performs services for their business, their company there?
Yes, yep.
Then likely yes, they would likely have a filing or a registration requirement.
All right, perfect. And let's check out the results.
All right, very good. So we'll move on here quickly, touching on franchise tax nexus. In California, there's no physical presence necessary to establish nexus for franchise tax nexus. Generally, California's rule is doing business, actively engaged in any transaction for the purpose of financial or pecuniary gain or profit. And then they also, beginning, I believe it was with beginning for tax years after 2010, California also put in place a factor-based threshold. So if you meet or exceed the certain thresholds that California has laid out, that will create nexus. And with California, it's not an either or. It's actively engaged or meeting the factor-based. So what that means is even if you're below those thresholds, you may still have franchise tax nexus if you're deemed to be actively engaged in transactions for the purpose of financial and pecuniary gains in California. So these are the factor presence. This is more of a bright line, threshold. As you can see, they are, many other states, it's more of a 50, 500,000. California does adjust their rates for inflation annually. So in 2016, the rates for property and payroll were $54,771 and sales were $547,711, or if 25% of your total property, payroll, and sales were in California. All right, that takes us to polling question number 2. True or false? Physical presence is required for income tax nexus in California.
And again, while we wait for those polling question results to come in, we did have another question come through the chat. Do out-of-state nonprofits have to file a franchise tax return?
I think it would depend on what their activity is in the state. If they reach the thresholds of doing business, and if they're or if any of their activities or their property, payroll, or sales meet the threshold.
Perfect. And let's check out those polling results.
Great. All right, well, we will kind of finish up here with closing out a business in California. So once you're registered or doing business in California, you're subject to that minimum franchise tax. That liability continues as long as you're continuing to do business, registering, incorporated or organized, and that liability remains whether you're active, inactive, whether the entity operates at a loss or operates at a gain. It continues until you take the steps to actually withdraw or end the business activity in the state. So if you determine that we're done doing business in California, we're no longer going to have employees, we're not going to make any sales, we really want to be removed from the state. The steps that you want to take, first, we want to get everything cleared out with the Franchise Tax Board. So file all delinquent tax returns. We need to then pay all outstanding tax liabilities, whether they be fees, interest, penalties, any fines, anything tax related, we need to get those liabilities taken care of. Next then is file a final franchise tax return. And you have to be sure that the word final is written at the top and the final box is marked on the actual return. One of the key elements of all of this, though, is that be sure no more California business it transpires after that final return is filed. If there is continued to be business, all the previous steps can be basically invalidated because continuing to do business will invalidate this process. So once the final return is filed for the California franchise with the California Franchise Tax Board, an entity has 12 months to file the final all the paperwork with the California Secretary of State if it's an entity that is registered with the Secretary of State to get everything closed out. And then while doing that, or once all that is done and you're no longer transacting business in the state, you'll also want to close out any sales tax permit accounts that are out there. Again, if you're no longer doing business, the sale of the business, change in ownership structure, those types of things are what we would want to make sure that we're considering if we're closing out this account. So the steps that we're going to need to close out the sales tax permit account, we would need to contact the California Department of Tax and Fee Administration. There's an actual form that needs to be completed, the CDT FA 65. Again, file all final sales and use tax returns. And another, again, the key to this is to make sure that we're not transacting any more business in the state. And in addition to filing the final returns, make sure any and all liabilities on the sales and use tax side have also been taken care of. So if there's any fines, penalties, fees out there, we'll want to make sure that those all get taken care of too. And lastly, if applicable, for example, if you're selling your business, a request for tax clearance may be requested by the purchaser. And what that would be, they want to make sure, so if you request that get that from the state saying, yes, all tax liabilities have been taken care of. If that tax clearance doesn't come back, or if a purchaser doesn't request one, what they may do then is set up, withhold some of the purchase or some of the proceeds, be set up in an escrow account to cover any future tax liabilities that may be discovered after the sale. So those would be steps to closing out a business or when you're finished transacting business in California. So with that, we will do our third polling question. Once your business is closed and has filed their final return, their final franchise tax return, how much time do you have to contact the California Secretary of State to withdraw and file all the Secretary of State paperwork? 72 hours, 12 months, 6 months, or 60 days?
All right. And our next question here in the chat box is, are services, installation, or consulting taxable in California?
Generally, I'm going to say no, but I will let, if Laura wants to comment on that.
Sure. So actually, that's really going to depend on, I guess, a little bit more of the nature of the project. So when you talk about services, that's pretty broad. Typically, California is not a state that would tax services. And when you say installation, there's There's actually a taxability matrix that's out there that California has, depending on if you're talking about like actual contracting, installation, you know, is it a lump sum contract? You know, there's a little more detail around that. I'd be more than, if you have like a specific situation that you maybe need a little more clarification on, you can feel free to email me directly after the presentation. I'll be more than happy to help you.
Wonderful, thank you. And let's go to those polling results.
All right, great. So with that, I will turn it over to Stacy, and she will take us to talk about California income sourcing. Thank you.
Oh, thanks, Jennifer. Okay, so I'm going to talk a little bit about apportioning and how you figure out what your revenues, how those revenues may be sourced to the state of California. And why is this important? I mean, obviously, you need to understand what your tax liability might be in California. So how do you figure that out? That's by apportionment. However, the sourcing issue is also really important when it comes to determining, do I actually have NEXUS in California because of the factor presence standards that Jennifer talked about. So as you recall, we have factor presence NEXUS in California, and it is based on property, payroll, and sales. Well, you may exceed those thresholds for sales in California and therefore have NEXUS. Well, how do you figure out if you actually exceed that $500,000? So that's where the sourcing comes into play, partly comes into play. So basically, if you're selling tangible personal property, it's a destination-based sourcing. So if the customer receives the goods in California, then that would be a California source sale. There are some nuances, and don't forget that Public Law 86272 is still alive and well, and it would potentially come into play for sales of tangible personal property depending upon a taxpayer's facts. Where it gets a little bit more complicated is when it comes down to the sale of intangibles or services, particularly in those areas because California has market-based sourcing. And some of you on here have probably heard this term. There's a lot of states that are going to this. And there's all sorts of different iterations of what market-based sourcing means. But for California, they basically say that if the customer receives the benefit of the service in California, then that revenue would be sourced to California. Well, how do you figure that out? I mean, where is the benefit received, or how do you figure out what that benefit is? They have some rules, and they define what the benefit received is, and they also have some specific rules whether your customer is a business or whether your customer is an individual. So there's some cascading rules, what I like to say are cascading rules, where if you don't meet the first standard, then you would go down to the second standard, et cetera. So my understanding also is that in 2017, earlier this year, the state had an interested parties meeting, and so we may see some more guidance come out about how to source specific services. So stay tuned for that. But the other part that I also wanted to mention was it could be difficult to determine whether a service, the benefit would be received in California or entirely in California. Say, for example, you were providing a service to a company who may be headquartered in California, but but they had offices all over the country or in other states. Well, perhaps that service that you were providing could be actually benefiting one of their other offices. So I put that out there because even though the headquarters may be in California and the billing address may be California, you may have an opportunity to not have to source all of that income to California. Okay, so we're going to switch gears just a little bit and talk about withholding. And some of you are probably more familiar with withholding as it relates to partnership distributions or flow-through distributions. However, do not forget that California does impose withholding on all sorts of California-sourced income to non-residents, whether it's on the sales of real estate, estate and trust distributions, covenants not to compete, some rents, leases, and royalties, and installment sale gains on tangible property. We're going to talk a little bit more about distributions, though, to non-resident partners. So there are opportunities, believe it or not, where withholding is actually not required. So basically, if you're a withholding agent, so if you're an entity that pays another entity that's a corporation, LLC, or partnership, and those entities are qualified and doing business and have a permanent place to business in California, then you would not have to withhold on them. However, you would have to have an exemption certificate, a Form 590. And if you haven't already heard, or may even be familiar with, California really likes their forms. I mean, I think Jennifer kind of set that out pretty well at the beginning. And so we want to make sure that we do the right form if we're going to claim a withholding waiver. And so Form 590 would be for those types of entities that would not have to be withheld upon because of the fact that they do have a permanent place of business in California, or are residents, or are already qualified with Secretary of State. So then you've got situations where withholding is required. So this would be required typically on any kind of entity or individual that are non-residents. And so what does that mean? That for the purposes of entities, it's that they're not qualified with the Secretary of State, but they're not maintaining a permanent place of business in California. However, they're receiving income from an entity that is. So generally speaking, that withholding agent, so the entity that's distributing the income, would need to withhold at 7% on California source income that exceeds $1,500 in the year. However, you might be able to claim a waiver for that, which is on the next, oh, sorry, I'm getting ahead. Let me go back. So the reporting for the withholding would need to be on a 592. So if anybody's familiar with how this happens for California, you'll know that the withholding itself is actually separate and apart from an actual filing of a tax return. The withholding occurs on forms 592, and then there's a 592B, which is a copy that needs to go to the entity that's withheld upon, and then that entity needs to include it with their tax return. So it's not just enough to claim the withholding. So like if you have a flow-through structure, it's not enough to put the withholding that the withholding agent withheld on the K-1 to the entity that had the withholding done on it. We also need to do a Form 592. So there could be situations where perhaps you've received notices, or there's questions from California have come back that said, hey, we can't verify your withholding here. And you may have said, well, it was on the K-1. Well, if you're getting a notice, it's because they probably did not have a copy of the 592B. And that's probably what they were requesting. So next slide here is a copy or what the 592B looks like. And again, these are not generated as part of the income tax returns. This is separate and apart. And then now we can talk about waivers, because it is possible. So if you are a non-resident and you are actually filing a return in California, then you would have the ability to get a withholding waiver, and that would be on a Form 588. And there are other situations perhaps where you would be able to have a withholding waiver, but basically that means you're presenting that withholding waiver to the withholding agent, so the entity that has the California source income, and you're saying, don't withhold on me because I'm filing a California return already, and I will pay income, or I pay tax on the income that's distributed to me. And then there's also the opportunity to get reduced withholding, again, a different form, and that's a Form 589. Okay, so we've talked about the 592s, and all of the basic withholding waivers and all the forms that may go with withholding. And Jennifer kind of introduced the whole concept of the forms and when franchise tax, the actual $800 is due, but we're going to talk just briefly. Here's a chart that I think would be helpful for some, because we sometimes see depending upon the type of entity, that perhaps the incorrect form might be filed. So for C Corps, it's a Form 100, and it could be a Form 100W or not, depending upon whether it's a Water's Edge election or it's a worldwide return. Those returns are due 4/15, or if it's a calendar year. Are those entities subject to $800? Absolutely. And Jennifer she had outlined when those $800 were due, at least initially. But once you pay up front, then you're subject to the $800 until you do all of the steps in order to get out of the state and not be subject to it anymore. So it can be a circular process in some ways. So S Corps file 100 S's. They are also subject to the $800, but also S Corps are subject to a 1.5% tax on the income of the S Corp. So that might come as a surprise to some because generally speaking, a lot of states don't tax S Corps themselves, they tax the shareholders. Well, California is one that actually does impose a 1.5% income tax on S Corps doing business in the state, regardless of the fact if they have a big tax or anything like that, they may actually be subject to at the federal level. So partnerships, be that, limited partnerships, general partnerships, et cetera, those file Form 565, and again, subject to the $800. LLCs have lots of different filings that they may have to do and are subject to certain additional fees. So LLCs, if they're treated as partnerships, they'd file a Form 568, not a Form 565. They're subject to the $800, but they are also subject to a gross receipts fee. So that would be on California source income that the LLC generated on its own. So if you had an LLC taxed as a partnership, then it would potentially be subject to this LLC fee if it were generating California source income on its own, and also be subject to the $800. And as some of you may be aware, those LLC fees, they max out around 12 grand. So it's a graduated scale, and depending upon the amount of revenue that's generated in California, and then it maxes out about 12 grand. Similarly, single member LLCs, whether they're wholly owned by a pass-through or wholly owned by an individual, they are subject to the $800. They need to file a 568 as well. They just don't have as many pages to fill out necessarily. And also subject to the LLC fee, which is, again, the gross receipts fee that caps out at the 12 grand. Now, where this can get a little bit dicey is in a tiered structure. So I see this a lot with real estate structures in particular, because a lot of times the properties are held in a single member LLC, for example. So you might have a California property that's sitting in one single member LLC, and it could be the lowest tier. Well, that single member LLC could be generating rental income from California, and then it would be subject to the $800 plus then the LLC fee on the rental stream. Well, then what happens is, because there could be other entities that are up the chain, so you could have like middle tier, upper tier entities, because of the fact that that lower tier owns California property, then that can create a filing requirement for other entities up the chain. But keep in mind that the California LLC fee would only be potentially subject, or what the LLC at the bottom would be the only one potentially subject to that, because they would be the only ones potentially doing business or generating California source income. If the entities that hold an interest in the single member LLC and all they're doing is holding that interest, they're subject to the $800, not necessarily the fee. They would have to be doing business on their own in California in order to be subject to the fee. Okay, so that's going to bring us to our next polling question. So LLCs taxed as S Corps have to file which form? Form 100, Form 100S, Form 568, or Form 565?
All right, and let's ask a question here in the chat box. What form would an LLC that is disregarded from their C Corp parent file?
They would file a 568 as well. All right. Did you hear me, Sarah, on that?
Oh, yeah, sorry. I was muted when I said
Okay.
perfect.
Okay, good. Oh, and looks like everybody got that, for the most part, got that right. It is a Form 100S because they had made the S election. The LLC had made the S election. Okay, so with that, I'm going to turn it now to Laura to talk about some sales tax issues.
Thank you, Stacy. Tara, I'm going to try to click it. Okay, I got it. Okay. So there's a lot that I could probably cover with sales tax in California, but I wanted to cover some high-level issues, things that we see a lot. The first thing that people usually jump to is, okay, am I taxable in California? Well, let's see first, before we go down up that path, if you have NEXUS. So on the screen, and granted, there's tons of these, but these are the main ones. For sales tax NEXUS, which is different than income tax NEXUS, pretty much you're looking at it from a perspective of, does your company have a significant presence in California? California has specific verbiage in their statutes. It's quote unquote engaged in business, and NEXUS is kind of similar to the cascading rules that Stacy had mentioned earlier. These are kind of a way of looking at if a company has NEXUS. First thing is physical location. That's pretty obvious. If there's a brick and mortar, if there's like an office, even if it's an office that you rent, that is going to create a sales tax NEXUS. Any employees, even if it's one employee, we see a lot of, well, our company's based in Texas and we have one sales person and they're in California because they work from their home. That's gonna, depending on if they have inventory and a couple other factors, that could create NEXUS. There's also affiliate or click-through NEXUS, and this is a little more complicated, but pretty much it's either a person that's directly or indirectly refers potential purchasers for property to, like, let's say if you're a real retailer, internet-based companies, that maybe you're hosting something on someone else's website. We're going to talk about Amazon here too. And then kind of the big one is attending a trade show. Now, in some states, since I physically sit in Arizona, if you come into Arizona for 2 days, you're going to have NEXUS. California is a little bit different. Obviously, they do a ton of trade shows there. They look at it more of how many did you attend in a 12-month period. So if you attended, I think it's 15, which is a pretty high amount, and your income or revenue for those 15 attendance at the trade shows was less than 100,000, then you're not going to have anything to worry about in regards to NEXUS. So another thing that I would kind of like to maybe touch on briefly is we see a lot more of companies, especially retailers, selling online. I've definitely seen some movement in that in the contracting area. They're beginning to sell some inventory items. So for the online retailers that are doing the fulfillment by Amazon, the FBA program, pretty much, if you don't know by now, anywhere that Amazon has a warehouse, a fulfillment center, a sorting center, even though it varies state by state, that's going to create NEXUS. And the reason why it creates NEXUS, even if you don't have a lot of sales there, is because inventory is being stored in those warehouses. Hence why there's been, if you've watched the news, there's been a lot of things about Amazon. Okay, now they have to start filing tax depending on how the sales are sourced. If you sell online, one of the things is that you first want to check is, do I have NEXUS? And then, should I charge tax? If you're a nonprofit, Probably not. Again, that depends on what exactly you're selling and what the nature of the transaction is. And a lot of resellers, if you're purchasing material and then you're going to be you're selling it to someone who's reselling it, that's another consideration. In that particular type, you would not charge sales tax. Okay, so let's say some of you may think, oh, well, we probably have NEXUS, or we think we have NEXUS. What am I supposed to do? Step one would be to get licensed. The way to get licensed is you contact, instead of the Board of Equalization, it's now CDTFA. It's really easy to do. It's free. You can go online and get your sales tax permit number. It's actually fairly simple. For those types of entities that only are in the state for a short period of time, California offers a temporary sales permit. You can also get that. Contractors are a little bit different. If you have a contract, if you do contracts in California, you technically aren't supposed to get a temporary permit, but there's a whole nother thing about locations. So, but mostly for retail, you can just get a regular license. Now, if you get licensed in California, you're also going to want to get a reseller certificate if you are a reseller. It's fairly simple to renew your license fees with them. One of the things that kind of gets a little bit tricky is there's also local jurisdiction registration requirements depending on your particular situation. California's failure to be registered and failure to file is actually pretty steep. They're not technically forgiving when it comes to if they catch you and you're in the state and you're not registered for sales tax. And I don't think that's shocking to anybody though. For sourcing sales tax, what I see, and this for online sellers, there's two ways to do it. Destination based is pretty much you're just taking a combined rate and you are, let's just say 6%. And that's what you're charging for sales tax. It kind of leaves it open to whoever you're selling to that they're required to collect or remit the district tax or the use tax portion of it. And when I say district tax in California, that kind of means like at a lower municipality level, so a lower jurisdiction. There is a hybrid method, which means you're technically trying to figure out two different rates. If you have a pretty sophisticated system, I would suggest the hybrid origin method because that way you're collecting the correct tax rate. It's a little more encompassing. For filing a sales tax return, you would think like a lot of states you're either monthly or quarterly. In California, more than likely you're going to be quarterly prepaid. Now what that means is you only have to file your return quarterly, but you need to go and make payments, they call them prepayments, monthly. So every time you file, you have to take credit for the past one payment or the past two payments that you made for, let's say, quarter one. It can be a little bit complicated. I do see a lot of errors that occur there, but for some reason, that's how California likes to do it. You could try to get monthly filing. However, it's typically it's at their discretion to whether they'll grant that filing frequency. And then annual is usually only reserved for those types of entities that have a very, very low sales tax liability for the year. Some basic common sales tax issues that I see are we're not charging the correct sales tax rate. Oops, I don't have the right exemption certificate. That's actually probably pretty common. I've seen it where they're electronic, but nobody checks to make sure they're properly executed, or we have them, we've had them for 20 years, they're in a box, neatly organized, but they're kind of like in a storage facility. That is probably the number one thing auditors will tend to look for is the exemption certificates, and then also good records. So taxability decisions, sometimes you'll see something that comes through and you apply it to your situation, however, it may not be accurate and it could be wrong. Also, not collecting local tax. can kind of get people, especially if you're operating in some of those bigger cities like LA or, you know, San Diego. And then selling to exempt entities. Now, normally, if you're selling to an exempt entity, they're going to tell you, hey, don't charge me sales tax. I would be cautious just to make sure that you are provided with the right documentation to ensure that they're truly an exempt entity and you're not required to assess sales tax for that particular transaction. Just really quick, and this is, I believe, the last slide for sales tax, is in a reconciling situation where you're dealing with multi-states. California is really big on receipts. Just making sure that if there was an adjustment or a change or something, that it's properly recorded. A lot of times fixed assets are purchased, especially big heavy machinery equipment. They're purchased out of state. Probably didn't pay tax when you bought it because you bought it in a different state. You bring it in, you didn't accrue use tax on it. That might be an issue. And there's the other side of it too, where maybe you did accrue use tax, but you didn't need to because there was a statutory exemption. A lot of internet purchases are made nowadays. Everything's done through Amazon. So you could order something online, you have it drop shipped to your location in California. There's no tax paid on that whatsoever. That's kind of tricky. It's really hard to track, but you know, there are some tips. Maybe we'll do another session on that, on, you know, some best practices. For taking products out of inventory, this only really happens in some specific industries. Let's say you had a really, you know, a Dell computer that you were going to, for some reason, sell, but you said, hey, you know, Laura needs it over here. If you take anything out of inventory and then use it, quote unquote, that's going to create a use tax liability. And then again, bringing supplies, equipment out of state. Now, for some reason lately, I've gotten a lot of questions about construction equipment. That can be kind of tricky depending on what kind of construction equipment that was purchased in a different state, because these, let's say you have or even software, you know, hey, we're going to use it here, but then we take it here. Every situation is kind of different. I would say before you, some cautionary advice is, if you're thinking of embarking on a new project, or maybe you haven't gone into California yet, you know, you can feel free to reach out to myself, Stacy, or Jennifer, and we'll be more than happy to tell you, like, here's some considerations, you know, here's what you might want to be careful of as in regards to sales and use tax. So, last polling question. Sure, it's not a hard one, it's true or false. So if you have, thanks, Tara. If you have employees in California, but no inventory, I should have put, do you have NEXUS? Or you have NEXUS, true or false? True or false? So you have an employee, no inventory, you have NEXUS. Fabulous. Okay, yes, it's true. An employee automatically creates NEXUS. Now, there are some caveats to that, but most of the time it's going to be a NEXUS creating activity for sales tax.
Okay, so I'm going to switch gears and I know we're getting on to the top of the hour, so I want to be sensitive to that. So I have a few slides here, but I think I just want to highlight a few things. You know, if you're in a situation where you think perhaps you've been doing business in California and you want to do something about that, and you've got some exposure sitting out there, they have had a voluntary disclosure program, but it's had some limitations. Thankfully, they did have a Senate bill that was enacted in September, which actually expands the eligibility of the VDA program. So if you think that perhaps this is an avenue you would like to explore, then the state actually is getting a little friendlier and providing a few more benefits to other taxpayers that didn't potentially qualify previously to be in the program. They have also put out some recent guidance on how they apply IRC limited 382 NOLs. One would think that, this is a concept that's been around quite a while. Wouldn't California have had guidance on this a long time ago? But they just recently actually provided some guidance that those IRC limited 382 NOLs would actually be applied on a pre-apportion basis as opposed to a post-apportion basis. Then, if anybody's familiar with the SWORT case, I will tell you that this is an evolving area, and the FTB is actually very much clamping down on this. In this case, SWORT they only had a very small interest in a LLC doing business in California. Ultimately, the FTB agreed that they did not owe the $800, going back to what I had talked about earlier with respect to the fact that if your only doing business piece in California is your ownership interest in a LLC doing business there, you still technically would owe the $800. That's the way that they've looked at it for years. However, SWORT had some interesting and specific facts where the FTB actually said, no, that SWORT didn't actually owe the $800. You may be in a situation where that could potentially apply to you, but also just be aware that the FTB is clamping down on these, and we're not seeing too many successes yet. Then also just don't forget, California actually does have a California Competes credit, and it has an application period, several application periods, one of which is coming up in January. So I wanted to note that this credit is basically for businesses that hire additional employees. So you already could be in California, but you're going through a hiring phase, or you're adding more CapEx into California. There's a whole litany of things that have to be filled out on an application. There's a qualitative versus quantitative kind of scoring that the state goes through, but do know that they do have this credit there, and there's a $200 million per fiscal year through 18 split that potentially could be awarded to taxpayers within these application periods. And then lastly, as if California didn't have enough taxes, don't forget about some of the big cities. The city of LA has its own gross receipts tax. If you're doing business in the city of LA, this very well could apply to you. They have lots of different rates that they apply depending upon your tax classification. I will tell you that $450 per thousand is actually kind of their catch-all. So if you don't fall within one of the other categories, they view that $450 per $1,000 as the catch-all. And then similarly, City of San Francisco has a gross receipts tax. It's actually being phased in to replace their payroll expense tax. However, they also have a business registration fee that's based on gross receipts. And as you see on this slide, there's 7 rate categories there. So keep in mind that if you are doing business in either of those cities, you potentially could be subject to these gross receipts taxes there. So with that, I want to thank everybody for joining us. I know we went a little over. Thank you for hanging in there, and I appreciate Jennifer and Laura contributing and being part of this presentation with me. Excuse me. So I don't know if we'll have any questions considering we're over, but I'll turn it back to you, Tara.